Good morning, everyone. Welcome to this month's digital workshop. It is titled Navigating Market Volatility. Hope I said that right. I don't say that word too often, so hopefully that's the correct pronunciation. My name is Desiree Hozak, and I'm glad you're here to join us today. First, we have to show you this disclosure. So if everyone would just glance over that for a moment, and then we'll get started. Okay, so many of us are worried. We're worried about things going on in the world today, the Ukraine war, inflation, COVID-19 mandates, or just personal issues going on in your lives today you're struggling with. We at Leonard Advisory Group are here to help with the ones we work with, give some peace of mind and guidance. And we hope to do a good job today of, giving you some, good insight on the volatility that's going on today. Now, Josh will be providing some context to the market volatility. He's going to be covering a little bit about the market downturns and how it affects your portfolio. Our goal today is to just provide easy to understand financial education, to help you, get through those tough times. And throughout the presentation, Josh will offer a 15-minute phone call to address your concerns. So if you're interested in that, always feel free to, to ask any questions. And if you know anyone, a friend, a relative, a neighbor who might benefit from our services, please reach out to us. We're here to help, and we want you to know that we do care, and we want to be the best, the best we can be at helping, through your goals and that, through retirement and just through everyday financial questions. So at the end of the presentation Josh has, we'll have a survey that'll pop up. And if you can give us some feedback to help us improve for future workshops, would appreciate it. And I'm going to throw this off to Josh, and I hope everybody learned something and is better at, a little bit of peace of mind and less stress. Okay, there's Josh.
Thanks, Desiree. Market volatility is certainly something that gives us all a reason to panic over time. We see the market start declining quickly, and we worry, what does this mean for our future? And, Desiree now, I think this is the 4th or 5th month, I've had her do a little intro for these webinars. And, I had planned to talk about running, which I will. Market volatility and investing in the market, much like speaking in front of people, even if it's in front of a camera or running, takes consistency over time. When we invest in the market, we get the best results when we make a plan, commit to the plan, and stick with the plan. So we'll talk about that a lot today. Running wise, I was planning to talk about my consistency running, which is important as well. But much like speaking, if I think back to some of the first times that I ran a webinar or did a public speaking event with my dad almost 10 years ago now, man, my shirts were soaked afterwards. I was all sweaty and nervous. And, we all grow and learn over time. But really, that consistency, keep pushing through it, is what makes you better at things in the long term. And much like investing, if we stick with that plan over the long term, we can get some great results. So last week I was in Dallas, and I was at a conference, and I was sitting at lunch making small talk with some other advisors that were in attendance. And I started talking to a young man named Greg, and he had told me he just finished running his first marathon. I thought, oh, great, I can talk to someone about running, because I'll torture y'all with talking about running, but most people don't like it that much. When I tell people I run all winter outside, they think I'm a little crazy, but I like it. It makes me feel good. And when I consistently do it, I can consistently pull some good results. If we look at these 2 runs that I have mapped out here, these are 2 half marathons that I ran on March 28th last year and the year before. We can see the times differ a little bit. My pace was about 30 seconds off, somewhat similar route, but I consistently have been able to run half marathons because I run consistently and try to stick to a plan there. even if I get a little set off from time to time, or if personal events cause my running schedule to get off, I push hard to stick with it over time. Now, when I was talking to Greg at this conference, he was telling me his marathon story. And his, much like mine, was one that we prepared for this race for a very long time. And when it came race day, we weren't necessarily worried about finishing the race, but maybe, you know, more technical details. Am I going to be able to run the whole thing? Am I going to walk too much? You know, pretty sure that we're going to finish it. And Greg shared with me that he started out in a faster time group than he had planned for. Now, if you're a runner or do any endurance sports, sticking with a pace over time is quite helpful. If we try to push really hard at the beginning, sometimes that's going to hurt us really bad near the end. We need to make sure we're storing up enough energy. So Greg had started out running in a faster group, and this led to a problem as the race went on. He thought, oh, you know what? I can stick at this pace. I'm in great shape. He kept pushing, and he said about by mile 20 of the marathon, he was in a ton of pain. He had to slow down and start walking. So although he ran the majority of the race at a faster pace, he actually finished at a slower time than planned because he wasn't prepared appropriately for that. So today we're going to talk about market volatility, investing, the stock market. This falls into an investment plan. The investment plan is only going to be as good as the whole retirement plan. If our investment plan doesn't match our goals, income needs, our legacy plan, our health plan, maybe even an appropriate tax plan, the investment plan can get derailed. We can lose track and end up in a worse position than we thought at the beginning. So in our investment plan and dealing with market volatility, we always want to think of it in the 5 arenas of retirement planning, that being income, investment, tax, health, and legacy planning. So although we're going to talk a ton about investments today, always keep in mind it's one piece of your total plan. And in order to have a good investment plan, we're going to need those other puzzle pieces in place as well. So let's get started here. What is market volatility? And right away, I am going to take an opportunity to paste a link in to schedule a 15-minute discovery call here. This link that I just sent out to you is for our podcast that will be releasing soon, but it works the same way. There's slots available in my calendar to have a 15-minute phone call or Zoom meeting with any of you that are concerned about market volatility. So what is market volatility? Market volatility is when the market makes dramatic moves in one way or the other. Well, we all like market movement one way if we're invested, and that's going up. The market can be volatile and still trending up, but typically people refer to market volatility when it's declining, when we see these massive swings, when we see the market drop 1% or 2% in a day. That's typically what gets us concerned. If we're making more money, most people don't complain. So what is a correction? So we hear this often quoted. People say, oh, the market is in a correction. Well, sometimes people say it's in a correction, but really it's just a 2% decline from the previous high. Technically speaking, that wouldn't be a pullback, a correction, or a bear market. Once we exceed a 5% decline from a recent high, then we're in a pullback. That pullback range is 5 to 9%. A correction is 10 to 19%, and a bear market is a 20% loss or more. So let's put this into context. Historically, we've had 27 corrections in the S&P 500 from 1945 to 1922. Again, that's a drop of 10 to 19%. So on average, we have one correction every 2.8 years. Now let's talk about that term correction. It seems weird, right? Nothing should be correct. Losing money should not be correct. Really where that term comes from is that the market is correcting its pricing. The market got too far ahead of itself. So we're saying from an analysis point of view, now those stocks are priced more in line with where their earnings are today. Again, I don't make these terms. I'm just telling you how they fall in. So out of those 27 corrections listed above, 5 of those since 1974 have turned into bear markets, or drop of 20% or more. So here's a nice big chart for you to look at. Hopefully your screen is big enough that you can take a decent look at this. But what this chart here is showing is in the gray sections. You can see where the markets have gone down and we've experienced those bear markets. We all know that that's not fun. The dark black rather is the bear market. Dark gray is a recession. So this is a sustained period of time. Of course, most recently we can see 2008, which had some strong duration, and then in 2020 again as well. And this is just referring to the S&P 500. So this would be a broad gauge of the US stocks. Now, depending on what indexes we're tracking or how we're viewing the market, how we're exactly aligned in our portfolios, we could see these declines be more or less. So what triggers market volatility? This is a common question that we get. What's going on? Why is the market going down? Well, this can be simply profit selling. So sometimes we'll see that the market gets really far ahead of itself, and we see people say, okay, hey, you know what? I don't think that this stock is really worth this much based on a fundamental analysis. So I'm going to go ahead and sell some of this stock off. I'm going to realize those gains and put the money aside, or look for another stock that I feel has more runway. We are also going to look at things like corporate earnings. So if companies had expected to reach a certain level of profitability or have so much in earnings during a quarter, and they're missing that benchmark, we'll see the company stock pull back. Sometimes with some companies, especially some of our high-flying tech companies that have done really well the past decade, we'll see them project earnings at a certain level, but they've always exceeded it by maybe 10 or 15%. Well, if they only meet their expectations, we'll see the market sell off around that stock as well. So sometimes corporate earnings or quarterly reporting coming out, we'll see some shifts in the stock market around there. Technical analysis can be another reason that triggers market volatility. So this can be various factors within it, but this is really digging deep into the numbers. Fear is another big one. So people are afraid of what might happen. So maybe they start to become more conservative in their portfolios. And then the last one would be a black swan event. So we would say COVID is probably our biggest black swan event that we've experienced here recently. All of a sudden saying that all companies need to shut down and we all need to stay home is something that is not planned for ever, right? We certainly in my lifetime, I never thought that this would be a situation that would occur. We could say that this war in Ukraine or Russia invading Ukraine can also fall into this category, as well as the mortgage crisis in 2008 as well. So what does a market correction mean to my investments? Well, first of all, it's normal. So I'll take it back to running and say, okay, well, whenever I run, sometimes I plan to do, average 9-minute miles. I run 3 on Monday, 6 miles on Wednesday, and on Friday, I'm going to run 10 miles. And my goal is to average 9-minute miles through each one of those runs. Well, maybe on Wednesday, it's colder than I expected, and maybe there's some ice on the sidewalks. Well, I might be running a little bit slower then, but I'm still able to keep my fitness goals up, and I'm still able to keep in shape, even if I'm running a little bit slower. I'd say the same thing happens in the market with a correction. We are going to have setbacks over time, but it doesn't mean that your investment plan needs to be completely changed at that time, nor does it mean that the whole world is ending. So first thing is we need to keep calm. We need to keep a rational mind during those troubling markets, because this can be the time that we sell and lose substantially. And I have a few graphs here coming up that'll help illustrate that on how we could really hurt ourselves even more by acting quickly and not staying calm here. So 2 things to remember: buy low and sell high. Historically, the market goes up and to the right. So as long as we have time and we're patient, we've almost always bought lower than when we're going to sell when we need it in retirement or maybe for our later years in retirement. Always investing, we want to have a longer duration for that. We want to have a long term. If we plan to take all this money out tomorrow, the stock market is not necessarily the best place for it. Now, that being said, we could have a dividend portfolio or a portfolio that's producing income that we're still using, but we're not planning to sell all those stocks in a short period of time. And as history tells us, this too shall pass. So we need to be patient and have patience with the market here. Most recent example here is going to be March of 2020. If we look at this chart here, this is about the last 2 years. So we can see here, March of 2020, stock market was falling like a rock. We were all quite unsure, quite unsure as to what was happening and what it meant for our future. I'm with y'all. I think at this time, you know, a big part of our job is working with our clients to help them stick with a long-term plan. When we had things like COVID initially hit, everyone starts thinking, oh, well, this time is different, right? And the market's not going to come back. It's going to take forever. Maybe it's like 2008, where it takes multiple years for us to get back. No one would have thought that the market would have bounced back and we would have gained as much as we had here. We were fortunate that we only had 3 clients make changes to their allocation during that time period. We worked hard to coach them through and, you know, tried to help give them confidence that, hey, you know what, your plan dictates that we've prepared for this, so we're going to stick with the plan. 2 of the clients that had requested us pull money out of the market for them, and then they're going to reinvest it later, are no longer clients. One of which, on their own accord, they had expressed to us that they were not satisfied with performance of their stock accounts. And we sort of took the blame for them pulling the money out of the market during that time period. Another one simply decided to go in a different direction after making 3 or 4 different changes within the account. They're still a client, but if we look back at that, we would see that they would have a lot more money if they had just stuck with the plan rather than trying to make short-term moves. So it's very, very hard to time the market, and the market often moves in ways that are very unpredictable in the short term and can be hard to forecast moving forward. So you might say, okay, Josh, I get it. You showed me a bunch of graphs. You tell me it's all going to be okay. And the market always moves up, but I'm still worried. So I'm going to say being worried is normal. And this is what we call the investor psychology cycle. So this is how many of us feel when we are investing. So we start out, we feel optimistic, then the market goes up. So we're getting excited. Next step, we're thrilled. And then, wow, I'm a genius. This stock or whatever the investment is has performed phenomenally. I'm so great. And then the market starts to decline. So then you start to feel desperate, you panic, you're despondent, and then at the bottom, you sort of hit this level of depression. Well, in this graph, we actually would have had less than we started with. So we feel like, man, I made a mistake. I'm losing money. That's not the point of investing. So from there, we start to get some hope as the market goes back up. We feel relief when we're above where we initially started. Optimism. Oh, okay, market peaks again. We start to see a decline again. We feel that anxiety. We start, you know, have this mix of feelings declining back down to fear again. These are normal feelings. I would say the biggest thing with the psychology cycle, we all go through it. Even as advisors, we go through that. We need to stick to the facts and always look back. I would say one of the most unhealthy things that we see clients doing, and I know some of you might be on this webinar today, some of the worst behavior that we see is doing things like checking your account balances daily. When we look at the history of the stock market, if we follow it daily, it goes up about 54% of the time and down about 46% of the time. So if we were to watch it every day, it would almost seem like, one day it's up, next day it's down, right? Pretty close to 50 on both sides there. However, when we zoom out and look at the long picture, well, the market goes up over time, right? We go back, it's averaging, depending on when you take a snapshot, somewhere between 9 and 10% over the long term. So we need to be patient. We feel it's more healthy to review your investments, you know, quarterly, take a look at it, make sure that you know what's going on in the accounts. But certainly having that micro focus where you're looking every day, especially in troubling times, can make you worry and maybe even act out in an unhealthy manner. Again, another chart here. Corrections in bear markets happen, and then they recover. So here we're looking back 2012, so the last 10 years through 2022. COVID, when we look at those initial shutdowns, man, it seemed like that was the end of the world at that time. But man, did we bounce back quick, and look at how much further we are now. If we go back 10 years ago, there was worries about the market there. Hey, we're going to bounce back into 2008. We sort of heard that narrative for about 10 years after that. Everything got optimistic. What's going to be the next thing that causes the correction or a bear market? And well, we certainly didn't know COVID was going to happen. Something will always happen again, but we always tend to recover. As this picture shows, the bear retreats. Maybe it'll go into hibernation, hopefully for a very long winter. And after that, we'll see the market start to pick up momentum again. I think when we look at graphs like this too, we often forget that the stock market represents companies. And a lot of the companies that we have, especially contained in the Dow or the S&P 500, are really amazing American companies that are doing great things, that have improved our lives drastically, and they're producing products that we're all buying on a regular basis. So while there might be a war in the Ukraine, that doesn't mean that Whirlpool here in Southwest Michigan is going to stop manufacturing washing machines and dryers and dishwashers, nor are Americans going to suddenly decide, hey, I'm hand washing my clothes again, and I'm hand washing all my dishes again, and I don't need those machines anymore. We will see cyclical cycles for stocks like that, but these companies are not just a graph or something else. These are people working hard to support their families, and they care about the company and moving the company forward as well. So we need to keep that in mind, that it's not just, you know, a name or a stock symbol or some numbers on a graph. These are real people's professions, jobs, and companies that they're running with a passion, trying to do great things for the world. So you'll say, okay, sure, great, Josh, that's all great, that's wonderful, but what's going to happen? I still am worried. I'm still right. I'm just going to sell out of the market. I'm going to sit back and just bide my time. So we call that timing the market, right? Once things calm down, I'm going to invest again. Well, timing the market, we say, is extremely difficult because you have to be right twice. One, you have to sell at the right time. And the second is you have to buy at the right time. So what are the realistic odds of you picking the exact peak of the market and then selling or at the peak? So selling at the peak and then buying again at the bottom. Well, next to nothing. Even some of the highest paid analysts are unable to do that. They might try and they might get close. But sometimes people make bets. We can even think of the mortgage crisis. For our office book reading that we do on a monthly basis. We're reading The Big Short now. I'm sure some of you have watched the movie in the past, and I've read the book before. And, you know, it's interesting. A lot of these people that they're following the stories of had sort of predicted this ahead of time. Now, finding the exact timing that people were going to be defaulting on their mortgages at a rate that you could short the market, so make it profitable, is extremely hard to do, even if your overall thesis is right. So timing the market is extremely difficult. We don't want you to bet on those odds. The other question that we commonly get there is, okay, well, maybe I should just switch investment strategies. So we call this the hot dot or a heat map. So this is going to show, going back over the last 10 years, what is the top and bottom performing asset classes. So if we look here back in 2002, if we'd say, hey, okay, I'm going to pick the top performing asset, I'm going to buy that and I'm going to hold it, right? If it did the best, it's always going to do the best. So we're going to stick with that. So that would have been commodities. In 2002, it performed at 25.91%. Well, the next year, I think we would have felt like we made a mistake. This was not the top performing asset, but it was still positive, still up 23%, although small cap growth stocks were up almost 50%. So I think I'd rather own that. The next year in 2004, commodities were up 9.15%. Mid cap value was the top performing asset that year. In 2005, 21%. Commodities are up top again, so you might feel reassured at that point. 2006, 2.7%. Okay, we kind of follow this gray square along the way. We can see in 2008, they lost 35.65%. Wasn't the worst performing asset, but certainly wasn't the best as well. And a 35% loss is something that most of us don't want. 2009, we saw it rebound, but certainly not a top performing asset. And then 2011 through 2015, we saw it perform negatively consecutive throughout that year span. If we look at a 20-year annualized return, we would have averaged 1.78. If we look at the middle of this 20-year analyzed return piece down here at the bottom, we can see a diversified portfolio averaged about 8%. If we would have been lucky enough to find the top performing asset throughout this time period, it would have been large cap growth. Now, if we looked back over a longer historical time period, we'd see that that wasn't the case. In fact, over a longer time, we would see that large cap value is something that's outperformed large cap growth. So it's very hard to predict the market, even over a 20-year time span. And if we're chasing these returns over time, we might actually end up with the lowest performing asset, or we might hamper our own growth. Let's talk about the Fang stocks. So these are some of the high flying stocks. If we look back, this chart goes back from 2017 to February 28th of 2022, supplied by Morningstar. This is tracking those Fang stocks. This we often share in our quarterly recaps as well. So you might be familiar with this, but I want to highlight here that even these top performing stocks, and when we look at these stock names, they are Facebook, Amazon, Apple, Netflix, and Google. These are names that we're all very familiar with, certainly strong companies. Until its recent peak of November 19th, those stocks were up over 320%. Now, they've shifted down quickly. These were some of the hardest hit stocks in recent pullbacks in the market. We can see the S&P over this time period has been up 85%, while still those high performing Fang stocks are up 219%. So this is a good run. Certainly we want to have exposure to those things in our portfolio, but if this is all we had in our portfolio, we would definitely be hurting at this time. So we want to stay well diversified and own, really more than 5 stocks, of course. A big thing that concerns us all actually is the war in Ukraine at this point. We don't know, are we now in a second Cold War? Will things escalate further and turn into World War III? It's hard to imagine this resolving itself quickly. So I pulled this chart from Morningstar as well. I thought it might be helpful for y'all to see some of these events that were very dramatic and troubling at the time, and see where we've performed, after that. So if we look at the Iran drone strikes against Saudi Arabia, first 3 months of that, 5.4%, 6 months after, negative 10%. 1 year after that, the market was up 11%. If we look at the Russian annexation of Crimea, here, the market was actually positive the whole time. If we look at the Iraqi war, market was up 27% a year later. 9/11, this one hurt us a little bit more. We had negative 17%. I'd say around that time we had some other events happening in the market that also helped drag the market down. I think the important thing, and the thing that I wanted to highlight on this slide, is even when we have these dramatic world events, many times the market ends up being a lot better than we might have anticipated. If we look on average, these are above long-term average growth of the S&P 500 1 year after these events. So we need to hang tight and hope for good things. So we had talked earlier about, hey, well, maybe I'll just pull money to the side. And this graph, if you've been to many of my presentations, I've used this in different forums for many years, because I think it's a great, simple illustration. And this would show in 2008, if you had decided to move your money to cash at that time and just stay out of the stock market at that point, you would have said, hey, you know what, my portfolio was doing good, but as the market pulled back, I just really wasn't comfortable with it. And from here on out, I'm just going to be a cash investor. I think I have enough to get by. So if you did that with average interest rates on cash or money market accounts, you would have started out in 2004 with $100,000, and today you would have, or as of February 28th, 2022, you'd have $130,000, 429. If you said, hey, you know what? That's not me. I would only put my money in cash for a year and I would be a disciplined investor and reinvest at that point. Well, that $100,000 today would be $442,000. So certainly a lot better. Now, if you would have just bought and held throughout that time period, that $100,000 would now be $728,000. So quite a substantial difference there. So this idea of we're going to pull everything to cash and we're just going to wait out the volatile markets can often cause you to miss some of the best growth in the market. Another piece that I want to highlight here is with this current situation with Russia. Russia is a large oil and natural gas producer. Their stock market has been just shut down through most of this crisis. And a lot of people are worried, oh, what's the impact on the world? So what this chart here shows is the global equity market by size. So these are publicly traded stocks. And if we look at this graph, this will show going back to 2008, what percentage of the market is affiliated with each country. We can see currently the US is right around 61% of the market cap. Canada is 3%. Europe, excluding the UK, is 12%. UK is 4%. Asia, excluding Japan, is 10%. Japan, 5%. Latin America, 1%. And all other regions, 4%. So if we think about the impact of various countries outside of the US, it certainly can have an impact on the US market and our stock market. However, most investors in the US have the majority of their assets linked to US-based companies. So we talk a lot about the S&P 500. The majority of it, although those US companies can also have impact because they'll have affiliates overseas, like in Russia, we are not going to see the full brunt of that shutdown. When we look at Russia as a part of the world US or the world stock market, it's really less than 2% of the total market. So even if all of those companies went bankrupt or never traded again, and you owned one equal piece of the pie, we would only see about a 2% loss in your total portfolio. So it is a risk. It is a real risk, but it's not something that's going to wipe out a total portfolio. Another big thing that we're hearing about is the debt. The debt is astonishing. It is astonishing how much money we've spent as a government. This chart I like to share to put things into perspective. We are far exceeding the global financial crisis, so 2008, in what we have debt versus GDP. So this chart here is looking at the annual federal deficit to the US GDP since 1930. So it's as a percentage. We can see here, as of 2021, it's negative 12%. During the Great Depression and World War II, we far exceeded that. So we have overcome larger deficits in perspective than what we are now. Certainly now it's the largest dollar amount ever. And there are a lot of other issues. Our economy is more mature now, so it might be harder to overcome this growth. I do deeply believe that the deficit isn't going to be something that sinks the country. We would see maybe in the future a decreased ability to lend at the rates that we are now, which is going to bring me to the next slide, which is who's holding our debt. So we often hear, hey, China's holding all of our debt. Man, if they call that in, we're SOL. Well, it's actually only about 3.6% of the debt. US held, so domestic entities are holding about 52%. The government's holding their own debt at 22%. We can talk briefly about that. For me, this year, my wife and I, or last year rather, my wife and I bought a 120-year-old home that we fully remodeled. So we took out a mortgage and, we had to put a lot of cash into the house to get it fixed up to a state that we'd like to live in it. So we did a lot of remodeling at a time when it was expensive. If I could just write myself a promissory note that I'll pay myself back later and somehow that generated money, well, that would have been an easier process for us. The US government has the unique ability, as do some other countries, that we can just write an IOU to ourselves. The government can hold their own debt. That's a great advantage when you're trying to balance monetary policy. Now, is it sustainable over the long term? No, I'd say not. We can't just keep writing blank checks forever, but it is something that we can use as a band-aid during troubling times. What we've seen during COVID is that, well, we really doubled down. In 2008, we took out a lot more debt, took a lot more leverage than we normally would as a country, and we really doubled down on that during COVID. So moving forward, it will most likely be the policy again next time we run into trouble, that the government will bring out their checkbook as well. But the idea that China or any individual international country has all of our debt and sort of has control over us in that way, I think is a common fallacy. You know, China has 3.6% of our debt. Most of it is in structured notes. So if there is a defined term on that, China can't just say, hey, you got to give me all this money or we're taking you over. It doesn't quite work like that. So it is a risk. We definitely don't want to have too much debt, but the idea that some other country owns us, I think is something that I want to kind of debunk here. So I gave you a ton of data with a bunch of charts saying, hey, everything's going to be okay. You get all that, but you're still not 100% comfortable. So I'm going to pull out an Oliver Cromwell quote here, and it says, trust in God, but mind to keep your powder dry. And what this is referring to is that, hey, you know what? We want to have trust that things are going to be okay, but we also need some security as well. So we want to make sure that, you know, okay, the market's going to come back, Josh, and everything will be okay. We have lots of challenges now. Everything will be okay. But how do I know that I'm going to be okay? So we put up 5 points here, 5 things for you to do to manage market volatility. And the first one, as I've noted a few times, is be patient. We all just need to take a breath sometimes, relax, and be patient. The second one is going to be don't overthink it. Resist your emotional instinct. So when we see the market fall, we say, hey, oh, I'm selling before I lose any more. Well, sometimes the market jumps back the next day, and if we sell, well, then we locked in that loss and we missed that bounce back up. So don't overthink it. Resist those emotional instincts to act quickly. We always want to make sure that you're staying diversified. Putting all of your money into one individual stock or one individual sector can be something that can amplify losses during troubling times. 4 is going to be review your cash runway. So we often talk about this with clients of how much money do you have in monthly expenses in stable or safe money. So if this Russian-Ukraine issue spreads into a world war and the market's down for a sustained period of time, how much runway do you have to cover your monthly expenses to be patient with the market? We want to make sure that that cash runway is meeting up with your goals. And many times when we meet with clients and simply talk through that, hey, between the cash in your portfolio and other stable or guaranteed investments that you have, you actually have 4 or 5, maybe even 6 or 7 years worth of income coming in. So really your market money still has a duration of maybe 7 to 10 years before we really need that money. Many times that gives clients enough peace of mind to say, hey, I can stick with that investment plan. So review that cash runway. And the 5th is, if uncomfortable, sit down with your financial professional to reassess your situation. If that's us and you're worried about the market and you haven't reached out yet, please schedule a 15-minute phone call. We can expand that to an hour-long appointment or however much time you need to address your concerns and review your plan. We are certainly happy to help you there. If you don't currently work with us, or maybe you've talked to us in the past but decided not to engage with us, that 15-minute call is also open to you. We can review your portfolio with you and say, hey, you know what? I think you're going to be okay. Or, you know what? Maybe you did buy too many tech stocks, and maybe we need to come up with a slow-moving plan to start reducing that risk over time. We never want to do anything super quick in the market, because even those those areas of the market that have lost money quite quickly might also bounce back equally as quickly. So we need to be patient there, going back to rule number 1. you know, as I've mentioned throughout, it is normal to worry. We worry about the stock market too. You know, at times, we'll hear from other advisors after big financial crises like 2008, but they kind of have PTSD, right? Because our job is to sit there and tell you everything's going to be okay. And we worry about it too, right? We study the markets. We know that over time, the markets bounce back. Things have been okay and we need to stick with the course. But sometimes we worry about those issues too. And standing in front of people and working with you to say, hey, you're going to be okay. You're going to be okay. That's normal. That's part of our job. So let us take that worry for you. Let us help you build a plan if you don't already have one in place that gives you some peace of mind knowing, hey, our cash runway dictates that we're going to be okay for a blank number of years. Again, going to zoom back out here and say, hey, that cash runway is really going to fall more into an income plan. For income plan solid, our investment plan is solid, our tax, health, and legacy plan are also well in place and functioning together. It can help ease some of the burden of market volatility. So we want to make sure that all of you do have a comprehensive retirement plan. We want to make sure that all pieces of your retirement plan are working together and not working against each other.